Welcome to the Max Dividends channel, where people build growing passive income, retire early, and live off dividends. In every video, one stock is broken down in detail, from business model to financial metrics. If this sounds interesting, definitely subscribe. Many exciting analyses ahead. Today we're examining the Coca-Cola Company, KO, global consumer staples giant. We'll answer, how does this company make money? Is it good for long-term holding? We'll go through Max Dividends checklist step by step, check financial condition, see if it fits our plan, and determine if the stock is undervalued today. How this company makes money. Coca-Cola makes money by selling concentrates and syrups consumed billions of times daily across virtually every geography and income level. KO is not traditional manufacturing heavy beverage company. It's brand distribution pricing power business with capital-light structure. Core revenue engines include concentrate syrup model, where Coca-Cola produces beverage concentrates sold to independent bottlers worldwide, handling manufacturing, packaging, logistics. This means high margins, low capital requirements, stable, repeatable cash flow. Global brand portfolio diversified across carbonated soft drinks like Coca-Cola, Sprite, Fanta, water and sports beverages, Dasani, Powerade, juices and dairy, Minute Maid, Simply Fairlife, coffee and tea, Costa, Gold Peak. No single product carries business. Consumption broad, habitual, global. Pricing power creates revenue growth. Few cents price increase. Applied globally translates meaningful revenue without damaging demand. Brand attachment and habitual consumption create demand stability even during inflationary periods. This capital-efficient model sits at intersection of everyday consumption, global scale, high returns on invested capital, cash conversion machine designed to turn daily consumer habits into predictable earnings and dividends. Is this a good stock to buy long-term? Step 1. Dividend history. We look for companies with consistent dividend growth over 15 or more years. Coca-Cola doesn't just pass. It's one of oldest dividend kings in market. As of 2024, KO has over 60 consecutive years of raising dividend every single year. The 15-year chart shows clean stair-step pattern from 2010 to 2024. Annual payout moves from under $1 per share to roughly $1.90 per share with zero breaks. Every year dividend went up, even through 2008-09 crisis, COVID, inflation spikes, rate hikes. At recent prices late 2024, Coca-Cola's dividend yield typically sits around 3%, putting it solidly in reliable income camp rather than high growth or high yield extremes. Step 1 passed, Coca-Cola is classic Dividend King and Royal Dividend Eagle with long consistent record. Step 2, 5-pillar secret formula. First pillar, sales growth. Over past 10 years, revenue first dipped, then rebuilt and moved higher. Sales moved from mid-$40 billion range in 2015 down into mid-$30 billion range as KO refranchised bottling operations, deliberately taking low-margin bottler revenue off books. From there, revenue climbed back into mid-high $40 billion range by 2024, driven by pricing power, product mix upgrades, growth in emerging markets. Sales growth passed. Top line isn't fast growing, but large, stable, slowly rising again, supporting durable dividend base. Second pillar, profit growth. Profits resilient with clear recovery trend over last decade. Profit started mid-$20 billion range around 2015, dipped into low $20 billion range as KO refranchised bottlers and absorbed FX and pandemic headwinds, then rebuilt steadily to approach $29 billion by 2024. Highest level on chart. Deliberate reset followed by consistent profit expansion as business shifted to leaner, higher margin brand and concentrate model. Profit growth passed. Profitability strengthened meaningfully, confirming Coca-Cola can continue funding and growing dividend. Third pillar, net income. Bottom line shows one notable dip but strong overall upward trend. Net income starts around $7 billion, eases into mid-$6 billion range, then drops sharply toward $1 billion around 2017, mainly due to one-time charges from bottler refranchising and tax changes, not core business collapse. From 2018 onward, net income rebounds and climbs steadily into $9–11 billion range By 2022 to 2024, company kept raising dividend even in weak year, signaling strong underlying cash generation. Net income passed. Apart from single one-off dip, Coca-Cola delivers stable rising profits, providing reliable earnings base. Fourth pillar, dividend payout safety. Payout ratio tells mostly stable story with one big outlier. Chart shows extreme spike above 500% mid-decade when net income dropped sharply because of one-time refranchising and tax impacts, while dividend kept rising. Outside that event, KO's payout ratio generally runs in 60 to 90% range. That's high, but not unusual for mature consumer staples company with very stable cash flows and limited need for heavy reinvestment. Dividend payout safety passed. Dividend well covered in normal years, backed by steady cash flows. But generally high payout ratio suggests thinner margin of safety and limited room for aggressive future growth. Fifth pillar, debt burden. Coca-Cola uses leverage, but it's controlled and consistent. Over past decade, debt ratio moved in tight band roughly between 0.72 and 0.79, staying well below 1.0 level that would signal aggressive balance sheet risk. No sudden spikes or drops, just stable pattern of moderate, predictable debt usage. Debt burden passed, leverage steady and manageable, no red flags for dividend sustainability. Company financial condition. Coca-Cola achieves financial score of 96, among highest ratings signaling very safe business built to endure. All 5 pillars cleared, durable sales, strong improving profitability, mostly stable net income with one accounting-driven dip, well-covered dividend, consistently managed debt load. Step 2 passed overall, high-quality Dividend King suitable as core holding. Does it fit our plan? Coca-Cola's max ratio of 4.34 places it in balanced Eagles category, with 2.90% yield, 24% cumulative 5-year dividend growth, and 65 consecutive years of increases, designed as solid, near 3% yield with slow but steady dividend growth. 5-year average payout ratio, 78.2%, means raises likely remain modest. Works best as core, low-drama income stabilizer, not high-growth name and not high-yield play, but dependable payer that helps anchor middle-of-dividend portfolio. Is the stock undervalued today? Cheaper than competitors? Max dividends shows Coca-Cola fairly valued versus peers, not clearly overpaying or getting bargain relative to other large consumer staples companies. Cheaper than its own history, slightly cheaper versus own 10-year average. Today's PE sits below long-term average, investors paying less per dollar of profit than typically over past 10 years. Better yield than usual, yield roughly in line with 10-year average. Current dividend yield around 2.93%, very close to long-term norm. Analyst consensus. Based on 15 Wall Street analysts, Coca-Cola carries strong buy consensus, 14 buy, 1 hold, 0 sell. Average 12-month price target $79.33 versus recent price around $70.11, implying roughly 13% upside. Final decision, Coca-Cola delivers quality, 65-year dividend streak, revenue mid-40B to mid-30B back to mid-high 40B, profits mid-20B to 29B, net income 7B dip to 1B, recovery to 9-11B, payout 60-90% with one spike, debt 0.72 to 0.79 stable. Financial score 96 confirms strength. Currently fairly valued with slight discount to own history. Solid core holding for stable income portfolio rather than aggressive growth play. Subscribe for more analysis. This is not investment advice.